Hello everyone. In today's video, I will be talking about I bond or inflation bond. My name is Vikas Shukla, and I have been speaking about the stocks, especially NEO, ACB, and few other stocks. But in today's market, as on 4th July 2021, we have seen that the S&P 500 is almost at all-time high, which means that there is a potential bubble, especially in some of the stocks. So, what could be a safer way so you could put into money and get some return out of it? So, I bond or inflation bond is one such place where you could diversify your investment. You know that the inflation currently is moderately high, between 2 to 3% or whatever, and it's maybe temporary, but it could keep on for a little while. So if you keep only the, do not invest into stock or anything, just keep the cash. Because of the inflation, your money will be able to buy less goods in, let's say, 6 months or later, if the inflation keeps like this. So one way to protect your money against the inflation is the I bond. And to give you a quick idea, at present the this I bond is earning an interest of 3.54% per year, which means if you invest $10,000, then at the end of the year you get an extra $354, which is not too bad. Now, a few things you note about the I bonds: you can invest a max of $10,000 every year, and then the interest rate is variable, it changes every 6 months. To know how the things work, the I bonds typically have two parts. One is the fixed part, another is the variable part that changes every 6 months. For example, currently the fixed part is almost zero, maybe 0.0% or 0.02% or whatever. And this variable part, which is inflation dependent, so if the inflation increases, this this variable part increases, and currently is 3.54%. So let's say in October 2021, the inflation is has reduced to something like by 0.5%, then this thing can actually go down to like 3%. But whatever it is, if the inflation is low, you get a lower return. If the inflation is high, you get a higher return, and your money is protected against that inflation. Some more things um, about encashing these I bonds. So it's best to wait until 5 years or so. Uh, you can encash it after 1 year, and in many cases, it may make sense to cash it after 1 year. And I would actually prefer to do that. But if you lose, let's say, between 1 to 5 year, then you lose 3 months of interest, which may be fine. For example, let's say the stock market crashes from its current high level to about 20 or 30% down. So, what you may feel like is that now is the time to enter into the stock market and start investing into the stock. So S&P 500 is, for example, 4,300 right now, and it crashes down back to 3,000, for example, which is 30 or 35% down. And maybe you may think that let's move, shift the to the stock market. So that's the one way of shifting this to this thing. But you will have to wait like at least like 1 year. So that's one thing you need to keep in mind. Um, Interest is compounded 6 months. It's not a big thing, but that's something you need to do. You need to go to treasurydirect.gov, just search for iBond, and it will take you to Treasury Direct, where you can go ahead and buy preferably the electronic one, but you can also do a paper one. Now, some of the tax considerations: you will have to pay the federal tax, and typically what you would do is, in the year, let's say 3 years later, you encash your money, then the amount of the interest, the total interest you earn, you will be reporting it to your to the IRS for that tax money. There is no estate tax. You could also report year after year, but I would believe that's too much of a paperwork. I mean, you'll have to keep a track record of what you file. So best thing is to report it in the year you encash it. You could possibly also, for example, if you have your kids are in education, you are paying you the tuition fees or whatever, then you can no, you can choose not to pay the tax against the tuition fee or educational expenses you pay. But it's not a big thing, but it can be substantial amount. um, for example, if you put in $10,000 over a period of 3 years, you get like $1,000 of the earning from the interest. Then if you are taxed in 30% bracket, you save like $300. These are some of the my views. I'm not a certified CPA. For more information, you may like to take an advice of a licensed or certified CPA. This is for your information purpose, which will prompt you to do some more research, balance mm, your risk that you by putting that you would usually incur when you invest into stocks. I hope this helps you. Thanks for taking a look.